Hey guys, welcome back to the channel. I hope you and your investments are all doing well. In today's video, we are going to look at some numbers behind property investing, as well as some research tools that I use to help me identify markets that are set to explode, as well as some markets I'm currently looking into and the ones that I'm currently avoiding, and most importantly, the reasons why. This is going to be a video packed full of useful information and some shocking data. So make sure you guys watch it till the very end to get a better understanding of how I personally navigate the property market. As always, please understand that this is not financial advice and I am not a financial advisor. I am simply sharing with you my personal opinions and strategies. I will always encourage you to do your own research and due diligence and seek the help of real financial experts before making any big investments or financial decisions. Let's start the video by talking about risk management. Look, I know this is a very exciting time for our property market. We haven't seen growth like this for a very long time. The last time we saw growth like this was back in 1988. So there is definitely a lot of FOMO in the market, with a lot of eager buyers paying silly amounts for properties and underbidders who missed out on auctions going back to the bank or broker to ask for more money. In my personal opinion, I don't think the rates will go any lower than this. And it is only a matter of time before rates start going back up towards the long-term average of 6%. When interest rates do rise, we need to be 100% certain that we have the ability to service these higher repayments. And I think this is something that most people are forgetting or simply ignoring. The mindset that a lot of people have right now is that property prices will only go up and that they have to buy a property right now at any cost or they will be left behind and miss out completely. Personally, I think this is the wrong mindset to have, and quite frankly, it is a very dangerous assumption thinking property prices will keep going up at these unsustainable levels. Look, I will be completely honest with you and tell you that I am very bullish on property over the long term, and I'm still purchasing properties in markets where the numbers make sense. However, when we see this kind of crazy sentiment and this kind of level of competition, and people going back to the bank asking for more and more credit and maxing out their borrowing capacity at these record low interest rates that will eventually rise, it makes me very concerned about certain markets. And based on what has happened so far in 2020 and 2021, for a lot of markets in Australia, the numbers just don't make sense anymore. If you have been looking at property for a while, and you keep going back to the bank and asking for more and more credit, and you keep increasing your budget over and over again, now might be a good time for you to just take a step back and think about all this debt that you're taking on and weigh up your options. I know what some of you guys are asking. What options do I have? Well, the most obvious answer is to buy a cheaper property. It is human nature to want the biggest, newest and most flashy thing that we can afford and then worry about the financial consequences later on. I personally use a strategy called rent vesting, and I share a 2-bedroom apartment with my housemate and I only pay $250 a week in rent. Despite being financially free, I simply don't see the need to buy $1 million house and then spend $3,000 or $4,000 every single month on repayments. And these repayments will go up as interest rates rise. That means I have to work harder to keep increasing my income just to service this mortgage. It really concerns me when young couples who are just starting out max out their borrowing capacity and buy $1 million house. That is a huge burden to carry over the next 30 years. Even in the hot market where prices keep going up month after month, we need to be financially responsible and make sure that we only take on debt that we can afford and never ever take on more debts than we can handle, because that can lead to consequences that will last for a very long period of time. Now let's get into the data and look at some numbers that make me very concerned about certain markets. Let's also start with our most expensive market, Sydney. With a median house value of almost $1.2 million, it is a very expensive market. There is absolutely nothing wrong with high prices, as long as the people who live in these markets have the ability to pay these high prices. However, this is not what the data is telling us. Based on the statistics released by the Australian Bureau of Statistics, the average weekly income in New South Wales is $1,751. Which is a very decent income, but not enough to service a mortgage of $1 million property. Using the NAB borrowing capacity calculator, 2 people with a weekly income of $1,751 before tax and a monthly living expense of $4,000 can borrow up to $979,000 and buy a house for $1.2 million. This is provided that they have a $244,000 deposit and $50,000 set aside for stamp duty, which most Australians do not have, and that they don't have any other debts like car loans or credit card debt, which a lot of Australians have. This means at current prices and this record low interest environment that we are in, most couples will have to max out their borrowing capacity just to get their foot in the door. And that's exactly what most couples are doing. What I'm about to show you next is very concerning, and I hope it gives you a wake-up call if you're thinking about maxing out your borrowing capacity just to get into a property. Based on our previous example, a couple who maxed out their borrowing capacity to buy a $1.2 million house will have a repayment of around $4,000 per month at an interest rate of 2.69%. However, if the interest rate increases to a 30-year average of 6%, their repayments will go from $4,000 a month to almost $6,000 a month. That's an extra $24,000 a year. The sad truth is that we are not going to see that kind of wage growth in the coming years or anytime soon. Look, I love Sydney as a city, and I would love to live there one day. It is a very strong market with very decent population growth, a lot of jobs, and very strong population forecast for the coming years. There are also a lot of high-paying jobs in Sydney, which is why there are so many multi-million-dollar suburbs. However, when the general population of a particular market can no longer afford to buy properties there, it makes me very concerned. Combined with the rental return on houses of only 2.4%, and a lot of housing supply because Sydney is such an expensive and profitable market for developers, it is a market I'm personally staying away from. If we look at Melbourne, it is a very similar situation with a lot of eager home buyers stretching themselves financially to get into the market. Melbourne is my hometown, and I could see myself living here for the rest of my life. It is truly a beautiful city with so much going for it: jobs, population growth, beautiful houses, and so much more. However, as a long-term investor, I focus on the numbers, and the numbers simply don't make too much sense here. With higher than usual vacancy rates, an oversupply of apartments in the CBD, a fragile economy due to our extensive lockdown, yet the property market is going crazy. This combined with the new state budget, which increases stamp duty and land tax for property owners with land holdings of $1.8 million or more, it simply discourages people to invest or build a portfolio here in Melbourne. If you have been watching my videos for a while, then you will know that I'm currently doing development here in Melbourne. And the new state budget simply encourages me to sell those properties upon completion so I can pull out the money and invest that into other markets that I think have better growth potential and better numbers. So if I don't like Melbourne and I don't like Sydney, then which markets am I personally looking at investing into in 2021 and the years to come? Well, there are a number of markets that I think are very promising. Again, this is not financial advice, I am simply sharing my personal opinion. But the markets that I really like are Adelaide, Perth, regional New South Wales, Brisbane, and regional Tasmania. Let's talk about why I like these markets so much and why I'm personally looking to invest into these markets in the coming years. Personally, I look at three main indicators to help me identify markets with good potential: the demand and supply of housing, the affordability of housing, and finally, the local economy and key drivers for growth. I look at the demand and supply of housing in a particular market as an equation. An increase in the demand caused by population growth while the supply remains low will lead to a housing shortage, which will in turn lead to both capital growth and rent growth. The perfect example of this will be what we saw in Hobart over the last 5 years. The housing supply in this small capital city simply could not keep up with the growing demand, and as a result, we saw a massive housing shortage and a massive increase in both the value and rent. But on the other hand, if demand decreases and supply increases, or if supply increases and demand stays stagnant, we are going to see a surplus of housing, which is exactly what we saw in the Melbourne and Sydney apartment markets. As our borders closed and we lost the inflow of tourists and international students, the vacancy rates in the cities spiked. This was followed by aggressive rent reductions by landlords who are desperate to compete for the remaining tenants, and lower price expectations for vendors who are looking to sell into an oversupplied market. Another important thing to discuss is the increasing cost of building materials and the premium that builders are charging, and how this affects the housing supply of certain markets. The end goal for all developers is profit. They want to make money and they want to see a return on the investment. And with the cost of building things, whether it's houses, apartments, or townhouses, increasing rapidly, it is simply not profitable for them to develop in the more affordable markets. Because the cost to build in these markets is so high and the median house value is so low, there's simply no margin for them to make. For example, I'm currently looking into a suburb in Perth where the median house price is around $350,000. And to build the same house in the suburb will cost around $300,000. As you can see there's not much margin for the developers to make there. The focus will instead be on markets with higher median house prices, such as Melbourne and Sydney, because there are bigger profit margins to be made, giving developers a greater incentive to add to the housing supply. And this is exactly what we have seen, with the housing supply in Melbourne and Sydney, our most expensive markets, increasing rapidly, while smaller cities like Perth, Hobart, and Adelaide deal with extreme housing shortages. So we have to ask ourselves, which market do we want to buy in, the oversupply markets or the undersupplied one? The second key factor that I look at is the affordability of housing in a particular market, because if the general population can't even afford to buy houses there, who's going to keep driving up the house prices? As we have discussed in the previous example, affordability in Melbourne and Sydney is a massive issue. And with so much of the population already maxed out at record low interest rates, where's the money going to come from to keep these markets growing? If we now look at a city like Perth, where the average weekly income is $1,840, which is much higher than the average for New South Wales and Victoria. Going back to the NAB borrowing capacity calculator, with an income of $1,840 per week and $2,000 a month of living expenses, the average worker in Perth will be able to afford the average house in Perth without even maxing out his or her borrowing capacity. This is compared to Sydney, where the average house will max out the borrowing capacity of 2 full-time workers. This is on top of extremely strong rental returns and less than 1% vacancy rate in most parts of Perth. This is why I see opportunity in this market. If we now run these numbers for regional New South Wales, regional Victoria, Adelaide, regional Tasmania and Brisbane, they all paint a very good picture, a much stronger picture than Melbourne and Sydney. With better affordability, higher rental returns and very low vacancy rates, which is a strong indicator of a shortage of housing. Another very important indicator that I look at is the local economy and a trigger for growth. In other words, is the local economy diversified and stable? Does the state government have favorable policies in place to increase migration and economic output? A perfect example for this is once again Hobart. I believe a large part of Hobart's success over the last 5 years has been the government's favorable policy towards migration into Tasmania. More specifically, the subclass 491 Skilled Work Regional Visa, which attracts migrants by allowing them to work and live in Tasmania for up to 5 years, which makes it easier for them to obtain their permanent residence here in Australia afterwards. I am by no means a migration agent or expert, so please correct me if I'm wrong. But I believe this has been very successful in attracting people to Hobart, the once very quiet and unknown city of Australia. These attractive visa conditions, combined with what used to be great affordability, really kick-started the Hobart property boom. And this property boom has now spread out to the other parts of Tasmania, and we are seeing significant growth in Launceston and all the other cities. Based on my conversation with a registered migration agent, the top cities for migration with open policies are Hobart, Adelaide, and Darwin. The final point that I want to discuss with you guys is cash flow, which I think is very important. In my personal opinion, when we start seeing this kind of crazy sentiment and this kind of explosive growth, we need to start preparing ourselves for a downturn. Now, this downturn could come in 2 years' time, 5 years' time, or even 10 years' time. No one can accurately predict this. A downturn doesn't necessarily mean a huge crash or a major correction. It could just be the property market going sideways for a number of years. We can look at it as a consolidation period for wages to catch up. This is not a bad thing. It is actually very healthy for the property market to see some sideways action after a very explosive growth phase. During a downturn, I think cash flow is very important because it helps you service your debt. And if you set up your portfolio correctly, you should still see capital growth while all the other markets stay stagnant. Having a strong cash flow will also help you take advantage of the great deals that will come up during a downturn. Just think about it. Investors with their negatively geared properties who are throwing thousands of dollars into their mortgage every single month and seeing the investments go down in value, they are not going to want to buy more properties. But on the other hand, someone with a strong cash flow can use that surplus cash to buy up all the bargains in the market and take advantage of lower competition and great prices, and accumulate more properties for the next boom cycle. This is certainly what I plan on doing. Guys, I hope you enjoyed the video. If you did, please do me a huge favor by hitting that like button right there and commenting your thoughts. It really helps out the channel. And I'll see all of you guys in the next video.